Greetings, everyone. Welcome to the seasonal website, the seasonal presentation, Navigating Seasonal Cycles, brought to you by the Foundation for the Study of Cycles, and I appreciate the opportunity to present to you today. What we do is not complicated, but it is detailed. If you get the details right, you'll be a very happy camper. If you don't get the details right, then congratulations, you're like most people. The good news about cycles is they are very versatile. They give us opportunities to do many different kinds of things, either as traders, investors, researchers, scientists, historians, economists, sociologists, etc. So as you can see, cycles are very flexible in what they can give us. In these sessions, I present the specific approach to cycles that uses seasonality. In other words, patterns that occur within the course of a year. Certainly, we could look at the 36,000-year cycle in Earth's revolution around the sun. We could look at ice age cycles, but those don't do it for me because by then I'll be long gone. So from the academic pursuit, cycles are very interesting, even you might say entertaining, and they create a sense of awe when you say, I can't believe it's happening again. But for our purposes, we're very pragmatic, maybe even mercenary. And by the way, today's date, I should tell you that, is the 8th of October, and the time here is 1:18 p.m. I'm in Santa Cruz, California. So what I want to give you today is a very specific presentation, clear and detailed, leave nothing to the imagination. Imagination for a trader or an investor is a bad thing. If you're a writer, it's a good thing. It's wonderful. But we're not writers here. We're strictly pragmatic. We want to unleash the power of cycles for the purpose of presenting profitable trades, finding them, and participating in them. Everything I tell you here is strictly educational. I'm not trying to give you advice as to what to do with your account, but I am showing you the methods that I've been using and developing for over 50 years, and they have significance to them. So if you find that it's not an academic presentation, that's exactly as I intended. I intended a specific, pragmatic application for seasonality. So today we're going to talk about a number of things. We're going to talk about pre-holiday seasonals, which are very specific. We're going to talk about the setup, trigger, and follow-through for these seasonals. And of course, we'll be using the absolute best tool for traders, history. In addition to that, we're going to talk a little bit about copper seasonals. We're going to talk about the rules and examples for the procedures. And of course, we're going to look at the seasonal selections that I made last time and the time before. In other words, I'm going to show you the trades that I selected based on seasonality, and then we're going to follow them through the month of October and see how they turned out. This is not a challenge. It's not a test. It's a specific procedure. I use it all the time. Most of the time it works. There's no guarantees. We don't guarantee profits. We don't guarantee that you won't take losses, etc., 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 and all the boilerplate regulations. So let's go forward with the usual disclaimer, namely that you can lose money trading or investing. It's not guaranteed. Let's go back now and show a couple of things. Everything we do, everything that I teach you, the greatest lesson that I've learned in trading is setup, trigger, and follow through. So in other words, every time you trade or invest, there must be a setup. A setup is a pattern, a specific pattern. As an example, a head and shoulders is a chart pattern. A breakout is a chart pattern. A flag is a chart pattern. A pennant is a chart pattern. A key reversal is a chart pattern. Fibonacci is a chart pattern. Elliott wave is a chart pattern. These are all patterns. The good news about patterns, as you've heard me say many times, maybe too many times, the good news about patterns is there are many of them. The better news about patterns is that you can find new ones all the time. The bad news is most patterns have no predictive validity. Remember that word, predictive validity. In other words, most patterns don't predict anything. We want patterns that predict something. Therefore, we use the computer to find those patterns, and of those there are a very precious few. Cycles are one of the patterns that have predictive validity. In fact, they're one of the best predictive validity patterns that we have. Once we have a cycle or a pattern, that pattern must trigger. In other words, let's say that we have a pattern that's been right 73% of the time for the last 30 years. The question is, what's going to happen this time? Because remember, 73% is not 100%. So we try to isolate those patterns that have the greatest probability of going forward as they have shown in their history. So a pattern needs a trigger. So you need a valid pattern and you need a valid trigger. I will show you some of those triggers that I've developed and used over the years. Once you have a pattern and a trigger, you need follow-through. Follow-through is the most important part of the whole process. Why? Because most traders don't have what it takes to follow through. They find a pattern that works, the pattern triggers, and then when it comes to the follow-through, which is determining your profit, determining your loss, determining when to exit that pattern, that's the most important part of the whole equation, because everything is built on the ability to take profit and to get out of the trade or the investment at the right time. I will show you a couple of these patterns as well as some triggers in today's session and in sessions going forward. Let's go to the next slide. As an example, if you've been reading the Foundation's newsletter, you know that about 2 months ago, I showed this cycle. A beautiful cycle in the Japanese yen versus the US dollar. As you can see from the bottom of the screen, it's a long-term cycle. It runs about 8 years from peak, from low to low. It's not perfect, it's not symmetrical, but it is a pattern nonetheless. And because it's a pattern, this pattern needs a trigger. In the article that I wrote, I indicated that the pattern was bottoming in 2023, and then going forward, we needed a timing trigger to bring the market higher, to confirm the pattern as effective. And so, one of the patterns that we use is right here, the moving average channel, which is part of my work. I won't go into detail on how to use the moving average channel, but I will simply tell you this. Right over here, where I have the vertical green line, was a trigger. So we went from this pattern, which was the expectation of a low, to the realization of a low based on the pattern and the trigger. The trigger then moved the market significantly higher, and in the process of so doing, it reached its profit target, which allowed us to get out of danger and take some money off the table. And then the pattern topped and started to go down. That's fine, because remember, this pattern that I showed you in the Japanese yen is a long-term pattern. If it was a perfectly symmetrical cycle, it would peak sometime here in 2026, and we're a long ways from that at this time. Therefore, the trend should continue higher for a substantial period of time. But within the context of what I do, this is still a long-term cycle. I'm not interested in long-term cycles for this presentation, but I will show you the combination. In other words, setup, trigger, and follow through, not just on long-term, but the process is the same on shorter term. And by definition of shorter term, I mean seasonal. Those patterns which occur within the course of a year. Now, I believe that since most traders are impatient, they want to use seasonal cycles because they're shorter term and cater to the trader's inability to stay with the trade. They give you opportunities multiple times a year. There are short-term seasonals which last a matter of days, some last a matter of weeks, some of them last a matter of months, but in any event, they are there, they're viable, they're testable, they're reliable, and they're very, very lengthy in their history. So let's go to the next slide. Here is another cycle. This one is not in the Japanese yen, but rather it's in Treasury bond futures. You can see that it's not perfect. It does have its zigzags, but within the context of the longer term, each of these points turned out to be a major low. And the timing was very precise, as you can see. Not perfect, but precise, which is why we need the timing trigger. So what did the timing trigger tell us at that time? The timing trigger on this long-term cycle, 2014 to 2019, 5-year cycle, the timing trigger said, it's time to buy Treasury bond futures. Over here, it was time to sell Treasury bond futures, but not without a trigger. So we turn to our rusty trusty trigger, which is right here in the next slide. And you can see that if you understand the rules of the moving average channel, you'll be able to see very easily that over here was a sell trigger, and the market has been down ever since. And then recently, and again, according to the rules, and these are specific rules, these are not interpretive, recently we had another buy trigger, which basically said that this cycle had not only seen its top, let me go back to that one moment, that the cycle had seen its top where we had our sell trigger, but now we've got a new buy trigger indicating higher Treasury bond futures. Higher Treasury bond futures translates into lower interest rates. So with this one chart, we have replaced a lot of economists and basically given you an economic forecast, namely that interest rates will continue to go down, which means that futures will continue to go up, and most likely until 2026, if it's a symmetrical cycle. And you'll notice that, interestingly enough, these cycles in interest rate futures have been fairly symmetrical, at least for the last several repetitions. It's not my intention to get into the long-term picture here. I strictly want to stay with short-term and seasonal, and so we're going to move on. If you like what I'm showing you, please let me hear from you. We always work better when we get feedback, because I certainly don't want to bore you. Let's go on to the next subject. Setup, trigger, follow through, which we've already been through. The main subject today is pre-holiday seasonals. Arthur Merrill was a brilliant man. In the early 1950s, he developed what he called his pre-holiday seasonal trades. This is his book, The Behavior of Prices on Wall Street. A classic book now out of print, selling for $325, but that's not the point. The point is this. Art made a brilliant discovery. He discovered that on days before major U.S. holidays, legal U.S. holidays, the Dow Jones Industrial Average had a very high tendency to close higher on the day. As an example, we know that Thanksgiving Day in the United States is always the last Thursday of November. Because the market is usually closed on Thursday, the seasonal trade holiday would be buy on the close of trading Tuesday, get out on the close of trading Wednesday. It's very simple. So it's a one-night stand. It's an overnight trade, suitable for many traders who don't have the patience to stay with trades. The interesting thing about traders that I've discovered is that they love to get out of their profits quickly. They like to keep their losses till they grow hair on them. And so, theoretically, this is a very interesting situation for the short-term trader because, again, if Thursday is November, Thanksgiving, then you buy on the close of trading Tuesday, get out on the close of trading Wednesday. It's that simple. So how does that fit into our setup, trigger, follow through? Very simple. The pattern that I just described to you is the setup. We can use a trigger to let us know we're going in the right direction. And follow through is the trade is over on Wednesday. I'm going to show you some statistics because without statistics, this means nothing. Let's go forward. I've made a list for you of the legal U.S. holidays. Let's go through them. And this is a list for calendar year 2024. So we have New Year's Day, the birthday of Martin Luther King. Unfortunately, we don't have sufficient data to do this trade. Merrill used data going all the way back to the 1800s. And if I can get at least 50 years worth of data, I'd be happy. So in a few years, we'll start including Martin Luther King Jr. birthday as part of the process here, once we've researched it to make sure that it's doing what it's supposed to do. We have Washington's birthday. We have Memorial Day. Juneteenth, again, not sufficient history. Independence Day, July the 4th. We've got Monday, Labor Day. And we've got October the 14th coming right up. We've got November the 11th, Thanksgiving Day, Christmas Day, and so forth. So these are all legal U.S. holidays. The procedure, again, embarrassingly simple. Buy on the close of trading before the day before the holiday. Example, we've got Columbus Day coming up, and this is the one I want to focus on today. We've got Columbus Day coming up on October the 14th. October the 14th, and the rule for Columbus Day is the second Monday of October. So the 14th will be the second Monday of this month. Because it's a Monday, and because it's the Columbus Day holiday, the market may be open electronically, but the rule for the trade is very simple. Buy on the close trading Thursday, get out on the close of trading Friday. That's all there is to it. We can talk about stop and profit targets as well, but let's just take a look at this trade. I'm going to go to the next slide. Just one moment, please. And let's take a look. This is the trade for July the 4th. This was July the 4th of this year. So the rule would be buy on the close of trading Tuesday, get out on the close of trading Wednesday. Thursday is the holiday. What happened? And remember, we knew all of this beforehand. We didn't have to stare at a bunch of charts, analyze the charts, call analysts, turn on CNBC. We didn't have to do anything here because we knew the statistics. The statistics are very simple. In sum total, these pre-holiday trades are correct about 74% of the time over the course of many years. Now, I realize that 74% is obviously not 100%, so we need to have some protection built in here in the form of stops and so forth. We'll talk about that. And by the way, if we don't have time to get through all of the stuff today, we'll have another session next week if the foundation will let me come back and find that I'm not too obnoxious or condescending. Let's go to the July trade. So here's July the 4th trade. And by the way, so far, every one of these major trades this year has worked. Now, don't get upset thinking that just because they all worked, then one that's coming up on Columbus Day this year is not going to work. That's not the way the process goes. So, October the 14th this year, let's go to July the 4th. So here's July the 4th on a chart. One moment, please. Here we go. This was July the 4th holiday right over here. So what's the rule? Buy on the close of trading the day before, right over here. Get out on the close of trading this day here, July the 4th. This is the exit date. This is the entry date. So had you bought on the close of trading here and gotten out on the close of trading here, it would be a very profitable trade in S&P futures. And you can see the small range on July the 4th because the market was only open half a day. That's all there is to it. Let me show you another one. Here is the seasonal trade pre-holiday for Columbus Day last year. So this was Columbus Day right over here. This was the day before Columbus Day. This was the day before that. Buying on the close of trading right over here, getting out on the close of trading over here. The trade is over. We're not going to keep it for a profit maximizing strategy. We have a stop. The stop that I like to use is I take the largest range day in the previous 10. So here is the entry date right over here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I'm going to assume that this is the largest range day over here. And this would be my risk for the trade in case it goes against me. Now, if you're an options trader, it's much easier. All you would need to do is buy an at or in the money call option at the end of this day, get out at the end of this day, and it's over. It's finished, win, lose, or draw. Don't make the mistake of staying in this trade if it's a loser. Do the action correctly and take your money off the table. If you want to trade multiple positions and keep some with a stop, that's fine with me. But I just want to show you how we focus in on a seasonal trade very specifically and consider the huge difference between this and the trade that we looked at in the Japanese yen. The Japanese yen trade covered years. This covers 24 hours. Very simple. So let's go forward and look at some more stuff. Here I've taken the rules and showed them to you. So the odds average about 71%, and these are the rules right over here. And the one that I'm interested in most of all is this. These can occur as a chance event once in 10,000 times. Therefore, this is statistically valid, and you can do it on the S&P, the Dow Jones, the Diamonds, the Spiders, the Russell 2000, or the OAX option. If you want to maximize your profit after you've gotten out of your trade, you can use a trailing stop. If it's a long position, you'd use a 3-period simple moving average of the low as your stop. Let's go forward. As an example, this is the current chart of S&P December futures. Here is where we are now, right over here. The trade we were talking about comes in right about here. But what's of greater importance is this. This is what tends to happen beginning around mid-month and usually kicked off by this seasonal trade 63% of the time to the upside as the beginning of a move. And this is the chart from last year. So we'll have to see what happens this year. Again, it's not 100%, but we tilt the odds in our favor with a very specific strategy and a very specific approach designed for short-term trading. Let's go to the next slide. One of the things that I've discovered is there has been a tendency over the years for markets to turn higher before the holiday. In other words, we're looking at a trade on the 14th of October. We're looking to enter that trade 2 days earlier. The question that I've always been interested in, is it possible that the market actually begins the move before that, so that if we can determine that statistically, we could actually get in earlier? If we go to a search and we ask the computer the question, show me all the trades for the month of October so that I can determine whether there's a tendency for this pattern to bottom out earlier and therefore make more money, I would go to the internet and I would do a search, which I'm going to do momentarily. But if I did that search, this is what I would find. I would find that there was a trade coming up on the 27th of October, which is rather late in terms of the seasonal we're looking for. We're looking for something that's much shorter term and begins earlier. So I would have to go back to the computer and study it further. But I want to show you this one trade before we forget. This is one of the best trades of the entire year, statistically. Buying December S&P futures, October 27th, getting out November the 8th with a 3% stop close only, has been right 84% of the time. Very impressive. And this is what it looks like in terms of the track record. Right over here. Now, don't make the mistake that most people make, which is to say, it's been doing too well. It can't possibly continue. Remember, it's a decision that you have to make based on the idea that you can only risk a certain amount. So if you're willing to risk 3%, which is the stop for this trade, right over here, 3%, then this trade is right for you. Or if you want to use an option instead, you could certainly do that. And what I'd like to do now is go to the internet and show you a search. Before I do that, let's take a look at the copper season. I'm going to skip through these for now and show you this trade. This is copper, what I call the top-down process. This is based on well over 100 years of history, showing cash copper in several different time frames. But the most important thing is these time frames all converge right over here in September and October. So within the context of what I show and what I teach and what I trade, is this a setup, a trigger, or a follow-through? Easy. It's a setup. It says that right now, September, October, November, start looking for a timing trigger to get you long the copper market, because an up move is coming, and this would be the character of that up move right over here. We can tune in on that even closer with Seasonal Trader. So we have switched to Seasonal Trader, but we're going to do a little bit of research. Let's begin with stocks. Well, actually, no, let's begin with futures. We're going to go to futures and we're going to look for copper, like so. And we're going to ask the question, are there any trades in copper coming up in October, November that will fulfill the seasonal pattern that I just showed you, like so? Very simple process. And by the way, you should be able to do this on any valid seasonal trading software. So this is not a sales pitch. Okay, then we're going to say, I don't want to risk more than 5%. And I want these to be relatively short-term trades. No, actually, let's do this. I don't want any seasonal trade that's been right less than 70% of the time. I'm going to put in a cutoff over here and find me those trades. Let's see what the computer says. Oh, computer says that there are no trades that match my criteria. It's important information. So let's come back to it and say, maybe I'm risking too small an amount. So let's try a little bit more. 9% risk. And see what happens. Now the computer is happier. And it says, yes, there is a trade coming up here from November 21st to January the 3rd. We can examine that trade in detail like so. By looking at the history. And we can see there's been a very lengthy history of 52 years, which is quite comforting. And at this point, ask yourself the question, does the method that you're using give you this much history, or any history for that matter? Because history is very important. You may end up taking some trades that are not historically valid. And this one is valid. Certainly this doesn't make me happy over here, but there's ways around that which I will cover in future sessions. So that's the copper trade that we search for, but let's do it a little more specifically. Let's return to the search, like so. And let's modify the search a little bit. And say, I want to look at December as well, because possibly we haven't been considering enough time. So let's look at December as well. Let's uncheck October and November, because we've already looked at it. So let's do December and keep the criteria the same. Now we're talking something really big. So these are the trades right over here. There's 8 pages on them, and the highest probability trade is 78.8%. Quite impressive. And let's look at the history. So this is the seasonal cycle that we're looking at. And the history is right over here. Again, 52 years of history. Let's look at the equity curve. Very nice. It's only had one substantial losing year, and this can be taken care of by buying some protection in the form of an option. But before we get far afield, let's go back to what we were talking about before. I'm going to return to the October holiday trade. Go back to here, return to search, and we're going to come back to seasonal trades, US stock trades, like so. And we're going to go to the S&P, and we're going to go to the month of October. And the reason we're going to the month of October is we're attempting to search for a trade that begins before the 14th and has high probability. So let's see what we've got. So here's the trade. It's the highest probability at 86%. But I want something that begins before the 14th. So let's sort the data by entry date. And we have here a few trades. In fact, we have some that begin around the 1st of October, which should already have taken place. So what you want to do now is investigate these a little bit further. These are all 80% probability trades that may already have reached their first profit target. The first profit target on a seasonal trade in stocks is the average profit per trade percent. So here's the average percent profit right over here. So the question is, from the close of trading on the 1st of October, have we made a move of 7% or higher, 7.48%? If so, then we've hit our first profit target. I'll let you do the math on that one. But what I really want to do here is this. I want to go to my saved seasonals, and I want to show you the list that I created. So US stock trades, and this is the one that I created. Okay, here's the foundations right over here. I'm going to open my file, like so. So these are the trades that I selected for October before the month started. We're going to see how they turned out. Win, lose, or draw. No interpretation. And do notice, I found all of these trades without resorting to fundamentals, without resorting to the news, without talking about geopolitics, without talking about any of that stuff. It's a simple trade. One moment, please. Let's organize the trades by entry date, like so. The first trade occurs on the 13th of October. So in these stocks, the trades actually begin on the 13th, which is one day before the 14th. So we can expect this stock, Google, Class A, to begin moving higher before the 14th of October. Let's take a look at the history for a moment, and I'll tell you why I'm doing that. So here's the history. And there's good news and there's bad news. The good news is it's a beautiful trade. It's had 3 losing trades. They've been relatively small. Last year was a winning year. We have all the statistics over here. The bad news, there's only 20 years of history. I much prefer more history. So let's go back and see the next trade. Home Depot with 76% accuracy, starting the 24th of October. And let's look at the history here. I'll show you what I'm looking for at the history. Just bear with me for a moment. Here's the history. 43 years of history. And again, try and get 43 years of performance history from the methodology you're using. It's not going to happen. There it is. Now let me help you avoid a rookie mistake. That rookie mistake would be looking at this chart and saying, it's gone parabolic. It can't continue to work. There's a recession. Interest rates are not going down fast enough. There's a war in the Middle East. It's never going to work. I could counter that by saying, think about all the hurricane damage and all the rebuilding that's going to have to take place, and how it's going to take place by people buying stuff from Home Depot. We can always argue fundamentals, but we can't argue facts. So that's this trade. And let me go back to the listing. Just one moment, please. And then we have one coming up in Cisco, the food company Cisco. And so these are the numbers. So what we're going to do is we're going to go forward and look at every one of these trades as they happen. These are not recommendations. This is simply my analysis of history, showing the specific process of finding seasonal trades on seasonal cycles within the course of a year. Let me show you one more thing and then you'll be rid of me. Let's go to percent wins. The highest percent winning trade is right over here. Textron, October 30th through November the 6th, with 82.5% probability. Let's take a look at it. I'll show you what a super good trade looks like. Here's the history of 40 years. And I say the more years, the better. And very consistent performer. There you go. That's the kind of layout you're looking for. So let me summarize for you. The pre-holiday seasonal trade we talked about. It's the work of Art Merrill from the book The Behavior of Prices on Wall Street. We fine-tune that trade. It's a pattern. We find a trigger. And trades that have been right 80% of the time or more do not need a trigger. The trigger follows specific rules with a profit target. Everything we do is objective and clear. It's simple. It's not complicated. It's not rocket science. But before you do anything that I told you, determine it yourself. See for yourself if what I'm telling you makes sense. If you understand the process, if you understand the rules of the trade and the regulations that we follow in terms of finding seasonal trades, and then try it yourself. Don't take it on faith. Don't just believe me. I want you to see it for yourself. So we're going to come back next session, and We're going to look at closer seasonals. And by the way, I'm going to show you something I've never really talked about, and that is it possible to use seasonality for day trades? Yes, right, you heard me. Seasonality for day trades. So come back next week, and by all means, if you like what you see, give me a thumbs up. Ask me questions. We'll get them answered for you. This is not perfect, but I think it sure beats a lot of old stuff that's out there. Thank you very much to the foundation. I appreciate it, and everyone have a great week.